Hello, ladies and gentlemen, and welcome back. Well, usually the time of December is a period in markets that we don't see much volatility. But in 2022, just like everything else, that changes. We're ahead of some of the biggest numbers. We've got VIX spiking out of control, CPI numbers coming out in less than 24 hours, and of course, trillions of dollars of options expirations happening this week. Where do we find ourselves? A pivotal area in the markets. We could theoretically be either going towards a massive ramp or a giant decline, filling a gap that we've left from the previous CPI number. Does PPI, the number that came out on Friday, tell us a little bit about what the market should do next? Well, let's deep dive into that along with our key levels moving forward for stocks, commodities, and cryptos. Well, welcome back everybody to the Daily Show. We'll be going through the lead indicators, the macro data, and then of course through the key levels that you need to be watching into the big news this week. But let's begin with the PPI number coming out Friday. It's what caused the market to initially drop down. Why? Well, there's a problem, not so much in energy anymore. We're clearly seeing that drop, but the problem is in food and services. And these are two of the major sticking points here for the Fed. The Fed will not be pleased with seeing food so sticky. Let's actually take a look at the chart over the last 50 years for PPI food, and you'll notice a similarity that they don't like, and that is a high level here, which is similar to the stagflation periods during the 70s. If this continues to be a bad read on the producer side, that generally feeds through to, of course, the consumer side. And that's why the market was freaked out about it a little bit. It makes the CPI number a little bit more interesting. And that's because it might be that, yes, we're killing inflation, but we're seeing it in all the wrong problems or wrong areas, such as things like rents, services, and obviously there's the big one, food. What does that do? It hurts the hip pocket of the American consumer, and it really weakens some codes such as XLY in the markets. Little wonder why this has become one of the most sold areas of the market in recent weeks, along with energy. Now, can we see where the PPI went up the most? Yes, we can. It's in the fresh and dry side. Does this mean that much? Well, again, we'll see it in the CPI number, but it may give us a little bit of an inkling. And do remember to follow us along at FX Evolution on Twitter if you want to get access to some of these charts as early as possible, along with some of our reports and other things we pop out. Let's talk about what's going on with the VIX, though. So a lot of people will look at this and they'll say, how did the VIX go up 9.5%? The market went up. Usually the VIX will only go up when the market goes down. Well, that's not necessarily true. What this is it's a huge amount of positioning ahead of news. Now, it doesn't mean that the news is going to be negative or positive. It just means that there is a huge amount of activity going on. And that's got to do with the trillions of dollars expiring, but also it has to do with just the real gravity of some of these things. Remember, we have the Fed interest rate decision, 3 other central banks coming out with their interest rate decisions, and on top of that, the biggest inflation read that we've probably seen in some time. It's really going to change the yield curve in the future, which we'll talk about later on today. So what does this mean? Well, I've gone through the data points here. We're not getting that much kind of correlation that helps us, but you have witnessed since 1990 to now, the 13th highest positive VIX day ever. There you go, some history there. So a few weeks ago, or about a week ago, we came up with this chart as a very distinct possibility of where the markets would go. As it turns out, we're exactly there. We're sitting around this 4,000 level. Now, one of the reasons why this tends to occur is because markets go back to a pivotal changing area. And we'll look at this later on when we do our S&P 500 analysis. But we find ourselves exactly at that 3990 to 4,000 zone ahead of the big news. And that's because if we do breach out above, we could be breaking all of the bears kind of spell on this market where they've been really heavily trying to sell the biggest trend line of the year in 2022. Let's move over to equity, put and call options. Something strange has been happening here. We're seeing a huge spike in puts being entered into around Wednesdays. Well, it could be just a coincidence, but that is occurring. We haven't necessarily seen the exact same thing that we had with previous upticks in markets in terms of puts and calls. There are unfortunately a little bit too many bearish people still in the market. And this is always problematic when it comes to markets selling off. It's one of the biggest issues that's really stopped this market, I believe, in 2022 freaking out. and that is that everyone, including the biggest players, are incredibly bearish. All-time record premiums paid for puts are still continuing to come through here. Here's one of the latest readings, and we can see that institutions are placing very few net bets on stock rallies at this stage. So if you believe the institutions are correct, they're not feeling that bullish, but they're also unfortunately placing a little bit too much negativity. And when you look at the option strikes, that will make some sense. It's in some ways forcing a kangaroo style market, which is harder to trade for the longer term swing investor. Have we seen it dip under zero? No. Have we seen it go negative like it did in 08 and 09? Absolutely we haven't, but this will be something that we watch over the next few weeks. One of the things for, or I guess the case for the bear side would be the MACD switch. This is actually a fairly negative sentiment indicator. We've seen statistics around these MACD switches to the negative side. Look at some of the other times we've had readings. We've already had one reading for 2022 and it boded very poorly. 3 months later, only 25% of the time was the market bullish, and the max losses were 10% over that period of time. So significant drawdown from the MACD side of things in terms of a switch at the bearish zone in markets. Does this mark up with conditional seasonality? Well, during bear market years, we can see here seasonality for the S&P 500 has notoriously been flat. The Christmas Santa rally didn't come. During normal years, we drop into the end of this week, usually around that 15th, 14th, kind of 16th of December, and then we tend to spike higher over that period of time. So here are the drops, and then we get those Christmas rallies. Will Santa come in 2022? Well, based on usual bear market years, no. But of course, based on the history of the S&P 500, you would say usually during these kind of periods. Let's move over to SeasonX just to show you here what you've got in terms of the December pullback and when it stops and when it starts rallying. You can see here that it's following a very similar trend this year. Again, we don't know whether it's going to continue to weaken. Let's move over to the competition. There's only literally a few more hours to get your competition in. If you're interested in entering, all you need to do is jump over to the links in the description down below and the pinned message. It's free to enter. Why not do it? Bit of a Christmas gift, hopefully to yourself, and you have the chance of winning one of 4 prizes, which we will draw on the channel. And of course, we wish each and every one of you the very best. So put your entry in. Why not give it a shot? It's free to do so. Let's move over to how the market's positioning ahead of the CPI numbers. While energy was the favored sector in the last 24 hours, it was the most hated sector for about a week. It's gone up 2.62. Makes some sense. We'll look at the sector a little bit later in today's video. Utilities also did very well, mostly because of gas and energy again. And then we had technology and semis coming up behind. If we look at the month-to-date statistics, though, it still shows us that defensive plays are still the best monetary play over the last December, basically, period. And this really shows us again that the market could still be trapping a lot of people into the inflation and the FOMC because they were moving mostly defensive during the last 10 days of trade. This is what we're always looking at. What's happening underneath? I want to know where the money flow is. And at the moment, as we know, the money flow has been mostly defensive. Let's now jump into the charts, and we'll start off here with some of the lead indicators. As we saw, VIX spiked out. Now, interestingly, this is actually very similar to the VIX spike that we saw some time ago when we broke through the downward trend. We VIX spiked, dropped a bit, markets rallied slightly, and then it was all bad from that point. Remember, the VIX shows us one important thing, volatility. It shows us concern in the market. Usually it is fear. Generally, it's associated with VIX spiking and markets going down. In this case, it's associated with expected volatility, and there is a lot of expected volatility this week, so do be careful out there. One of our charts for 2022 we believe that we'll be watching is basically the Fed, and I like to call it versus the market. So that is the Federal Reserve will be still continuing to try to get this rate up to where they need it at this time of recording. Seems like about 4.8 to 4.9% seems to be where they get the rate to in 2023. And then we find out how sick the economy really is. Expect this to invert pretty heavily. I believe the 3-month and the 2-year will be one of the most inverted charts of 2023. And the reason is simply this. If The longer the Fed have to hold the rate high to stop this sticky inflation, if it is sticky, remember, it's not just the drop in inflation that's going to be key here in the number. It's, do we see food going down? Do we see rents going down? Are they where the inflation's at? I don't care about energy. Probably the market doesn't either. That one's easily fixable. It already is fixing itself. We need to know about the food side of things. And I believe this chart is going to show us the true health of the economy moving forward. We won't stick any more to yields for now. Do go watch our videos or check out our Twitter as well at FX Evolution if you're interested in the forward yields. We'll do an update of that coming off the back of the inflation number and the Fed. It's going to be a very busy 48 hours for sure. So definitely subscribe to the channel. We'll be covering all of this stuff moving forward. TLT. Now, this is the probably most preferred trade of many traders and investors out there. I do actually think that it looks kind of negative here. Everyone's talking about it. I'm a big fan of it medium to long term, but most people are trying to trade it on the weekly in 2 weeks. It's a bit problematic. You've actually got an island style reversal here. In the live stream, I kind of said that. It started off rallying pretty heavily, ended the day 0.32 up. It looks like it wants to go negative, maybe down to this green box. Predicting it in front of the inflation number, though, will be tough. But overall, there's still a lot of upside on TLT just to get it back to where we were in February. Remember, that just means that basically rates need to be cut aggressively. That's what TLT is rallying off. It looks like this on the yield curve so far. And basically by 2024, they've expected to rate cut around 1.5%. This is what the market expects. So if that comes true, TLT obviously will go up further. If it gets even more rate cuts, 2% or something, TLT will do even better again. That's part of the story here. People are moving into Treasuries. It's become the trade that everyone wants though. So you do need to be careful at those points in time if you're trading it on the smaller time frames. What about the PCC? Well, the put call ratio, as we saw, Wednesdays and Tuesdays were pretty wild for the put call ratios. I've just marked out the previous kind of turning points for the market, that is the stock market. And what you'll notice is in those areas, we actually saw the PCC drop down under this 0.8 zone. Now, we didn't really see that this time around. Remember, only about a week ago, we were at those highs for the market. Now we've dropped off. We didn't quite go down as much as possible. And that's because there's still so many puts in the system. And while calls have come back a little bit, not in the biggest way possible. And that is one of the problems. And we'll talk about that later. What about the dollar index? Well, it hasn't broken some of the key levels that we wanted to yet. If you're watching the live stream, we did see the rally off this area. We haven't broken above this area I've just set an alert for, which is 10526. And I'd like to see the inflation numbers push, that is CPI, push us through here. And if you're looking bullish at the dollar, you want to see that 106 getting cleared. That's going to be a very, very big point. For now, most retail traders seem to be trying to short the euro US dollar. So therefore, effectively, they're trying to go long dollar index as well. That's a fairly crowded trade. I would call this relatively neutral. If I had to pick, I still do want it through this zone here. That seems to, but it's really going to come down to the number. Be very careful over the next 24 hours. We'll keep scrolling back from that. Now, gold's a different story. This certainly did show signs of mass negativity in the previous video we did. It rallied a little bit and then dropped relatively well, actually. It dropped down a decent amount of percentage from 1795 all the way down below 1780. So let's have a look at the daily close here for gold. Again, coming off this very critical zone. We've seen this act as a massive short previously, and we've seen it again acting with some big shorts. Huge money coming in here. Again, wick rejections. Ultimately, this one will be changed. We're at a critical point ahead of news. This is a classic type of thing for the market to do. If we breach underneath this area down here, then we're probably going to see some further weakness, maybe pushing us down into the low 1700s for gold. At this stage, anything is realistically possible. It does look overall negative on the current smaller time frames. That would be the generaling position. 4 hours still remains very much in the bull side though. So you've got another one neutralized at this market. The good news for you is once we see these two bits of news coming out, we should get way more direction and some nice trends coming through. But at this stage, it is very close to call here for gold. and of course the euro and DXY. What about oil? Well, I've marked out the same level that we talked about, which is the 78 or 77.50 for the barrel. That ends up coinciding with the 2-hour 200 moving average. And what you'll notice is that the markets have rallied here. They're still very negative on the weekly. And there's a key level that I think a lot of people will be spotting, which is this 75. I wouldn't be surprised at all to see oil bounce that, move into this 77 to 50. And if bears are still wanting to commit further to oil, which I suspect they may want to, that's probably going to be a level of interest around the Fed statement and, of course, the CPI number as well. This is going to be a key one. Now, why do I say that? Well, it has partially to do with that weekly close. It was pretty bearish. It came down fairly hard. A lot of people, including myself, have wished for the 65 to kind of 67 a barrel. I've been talking about that for a while now on the channel, ever since 120, really. And I still would like to see it there. Now, I could see it doing this very, very easily. So watch that zone. In fact, I'll set a little alert for it. You always want to have your alert set for during news and make sure that you're ready if these zones do get hit so that you have a plan to potentially enact. I'm not sure, though, if a breach of this zone up here, like a takeout of that area, will continue to rally. I would think there's sellers here, and then maybe we come down, we find out who wants to be the winner at that point there. So energy, certainly one to watch. Now, if we have a look here at XLE, just before we go into the rest of the stocks, again, you'll notice that we had that huge distribution. Most of you in the community were very much on top of that. We saw those series of lower peaks coming through. That's led to weakness. We've hit basically the role reversal area. We're not quite in the red box yet. So I'd like to see, again, further weakness on the energy sector. And this is going to be a little bit, again, around the Fed, around the CPI number. We'll have to find out how that all looks. But at this stage, this distribution has certainly worked out quite nicely. And for people that were taking profit ahead of CPI, they've done quite well. Let's move over to Tesla. This is where things get very disconnected. Now, Elon and the old Twitters, it doesn't seem to be good for the Tesla stock owners, unfortunately. There's two stories here, though. One of them is Tesla weakening. The other one is just the American consumer looking really bad. Remember, if food is increasing and rents are increasing, that puts a massive amount of pain on the middle class, the lower class, even the upper middle class. They'll start tightening up. They don't go and buy cars. They don't go and buy high ticket items. This is what's probably happening to many of you out there, unfortunately, and also some of your friends and family. People say, I bought a car a few years ago. I don't need to buy a new one. Now, obviously, Tesla is only partially the car story. It's partially the Twitter story. It's all sorts of things. But the price action has shown us weakness here over the last couple of weeks. And I don't like that number. It's now or never for these buyers to come back in. If they get another weekly close underneath this 170 zone, I've said it for a while. I still think this 136, 123 is very, very possible for Tesla stock. And it has to do with mostly consumer demand just drying up and price compression coming through. XLY, which is consumer discretionary, has been one of the most hated sectors for quite some time in the markets. And unfortunately, a big part of that is Amazon and Tesla. Let's move over to what's going on with options. We've got Apple here. We'll just quickly do a quick refresh on the Apple moving into the 16th. Let's take a look at what's happening with the option strikes. And you'll notice that, again, we have a 144 strike price, a max pain literally sitting pretty much straight on it. And we have a huge amount of calls sitting above the basically 145 plus. So you would think that the market's at a very happy area coming into this inflation. It probably doesn't want to go super, super low. That is, it doesn't want to probably push past 130 for Apple, but it also doesn't want to go too high and pay any of these calls out. So somewhere stuck between here would be, let's call it A-OK, very ideal, 1.476 million units. Let's have a look at Tesla as well. So we'll load up Tesla here. Just a point at the 16th, and you'll notice there's a ton of 150 puts and 200 calls. So you would probably not want to pay either of those out. Stuck between these zones for the week would be, again, the positive area for the markets. Now, max pain for the actual option strikes for Tesla is actually quite a lot higher. So if you are feeling bullish, the numbers come out. Possibly there's a ramp here that could just be purely options manipulation. And that's why it's going to be such an important 24 hours here for this stock. Let's move over to Apple. Apple has done okay in the last 24 hours. It didn't trigger any of our sells. If this does happen, market should fall. Where do we end up being? Somewhere around that 135. As we know, 130 holds a ton of puts. So yeah, expectation is if the inflation number is not to the liking, we should move down to around this support fairly quickly. If inflation is all good and everyone feels great about it, then we'll probably move to around that 148, 150 zone. It makes sense to the option strikes right now ahead of Friday. The consumer discretionary versus staples sector continues to go down. This shows us the American consumer is considered very sick by the market, not by our opinion, but by the market. And it basically just shows you that the expectation of demand is going to reduce. Everyone's going to, unfortunately, feel the pinch during 2023, and the market is going to demand that the Fed, if we can kill inflation, will do something about it. XLE, we talked about that one before, so let's move on to XLF. A fairly strong day for financials. Again, we had the high, the low, the higher high, and now the lower low. So even after inflation, even if there's a ramp, this is still a very real possibility for financials. A new low caused under here will be another one of those signals that things are not okay with this market. I particularly want to see this sector, though, fail, and if you want bears to be in control, because as we know, semiconductors often lead, or they're the most important sector in some ways to the stock market. If they fail and they move underneath this kind of 212 area, then this could show us that this was all part of a distribution. And if it's part of a distribution, there's usually further falls to be had. Remember, we've got a gap close at 193 for semis, and we also have a 3750 S&P 500 gap close that's still very, very possible. Let's move on to the indices. We'll talk about the DAX first. Nothing much to report here. Still stuck ahead of the big news, ahead of all the ECB and everything else that's going on. So expect that to react pretty heavily over the next 24 to 48 hours. We've got the US 2000, the Russell 2000 coming back to a key level. Previous supports becoming resistance. Where do we find ourselves? Really no surprises. We saw a rally. Big level to break through for the bulls will be getting through 1833. And for the bears, all they'll be doing is trying to push this thing back down. And if you have a look at IWM, what you'll notice is that the key level is going to be somewhere around this 174. And that's because that's where the gap close will be had, and previous supports and resistances are on the Russell 2000. So make sure to watch that index. It's still a very important one. It shows us the inner workings of the zombie companies, because remember, it's 2000 companies. There's a lot of bad ones in there. And also the smaller companies, not the mega caps. And that's usually the health of the US economy as a whole. Let's move over to the NASDAQ. Again, we've got a highlighted area here above that 11,825. Little drop, then base, then drop. We haven't tested that area yet. Usually with news, you expect it to kind of spike like this if this is a good supply zone, and it kind of jumps, looks like it goes bullish initially, and then it will drop off. That tends to be the kind of way markets and algorithms work. They go in one direction and then go the opposite one straight away. I'm sure a lot of you in the comment section have been hit by something like this before. It's not really giving us any inkling to whether it wants to be super bullish or super bearish just yet. Let's move over to the US 500 now, the S&P. Where do we find ourselves? Well, like that image before that we took a few weeks or a week ago, it's pretty much done exactly as we expect, and it's rallied back up to this 4,000. Now, we do have this little base here. We're testing that area. We didn't end up making a lower low here, which is interesting. So we didn't quite test the lows or break past those. We know where the critical levels are. We know that if the market is able to get underneath the 3,900 and close it, very important, not just go woohoo, wick. Now that's going to be a totally different scenario. But if we do close underneath here, there's a high chance likelihood that we trundle on down to the 3,750 close. And that's because that's where the gap is. That's where probably Wall Street would like to accumulate. So you can make a lot of arguments here. You could argue that this is a head and shoulders formation, left shoulder, head, right shoulder. You could make an argument that this is clearly a short zone. Some people would. I don't blame them. It's certainly a critical area. If we breach and we make a high above here, there's a good chance that if the market does come down, there's actually buyers waiting to meet it around this area. Got to be very, very careful. Going into bits of news like this, usually most experienced traders use options to mitigate their risks. Obviously, you can do whatever you want. You can also not do anything, which is a good thing about markets. You have the choice. But yeah, there's a lot at stake. And this is basically a neutralized area for the markets. A big rally, a push above here. We have to start to rethink about what our expectations are. Probably 4,200 would be the next level that we think the market will go to. But if the markets do reject in the next 24 hours, and especially if they get underneath 3,900, 3,750 seems like the obvious choice. And it all has to do with that previous inflation number, which is a huge ramp. Remember, inflation numbers have caused the biggest, craziest moves during this period of time of 2022. These are just some that I remember. I can't remember if it's that one or the other one, but these are some of the inflation numbers, and you can see they're upwards of 5% moves on the market. So little wonder why the VIX was up moving into this. Let's refresh here, which I've already done for the options expiration on Friday. Still a ton of 380 puts. They weren't closed. Still a ton of 420 calls, and 400's becoming one of the interesting strike points, along with 390 this week. So keep watching these. If they start expanding out after the Fed's information and the CPI comes through, then we'll have an idea of where markets might technically stop and find some buyers. We're completely neutral, unfortunately, if not a little bit tinged bearish coming into the inflation numbers, purely because of the way the market has currently acted. Let's move over to Bitcoin. It's still in a holding pattern. It dropped, it rallied, it hasn't fallen under this 16.6, and it could be either a huge distribution followed by a mass short off if it gets underneath here, or it could be just an accumulation towards rallying, trying to get that 18,000 put in. We don't know yet. We're going to find out. This is the problem with news, but remember, you have the choice. If you don't wish to trade into news, you can do whatever the hell you want. And that's the great thing about markets. You have the choice. Let's look at the big numbers coming out. So we saw those PPI coming in a little bit hotter. People are concerned about that into the inflation numbers. 8:30 a.m., 1 hour before the market opens. Yep, we're going to get the big one. We'll have the inflation numbers coming through. Will it be as hot as they expect? Obviously, they do expect a drop to come through. The main thing is going to be, where is the inflation? That's going to be the concern. I don't think it's going to be in energy. I would expect the drop to come through, but will it be in food? Will it be in rentals? Like, this is the big one. Then we've got the federal funds rate. Everyone's guessing on that as well. Will it be 50? Some people even saying 75 basis points again. I guess I'd probably go with consensus here. I think 50 is my best guess, but hey, I'm not an economist, so how would I know? These are very wild guesses in general, and ultimately, what edge are you going to have? Do you even know the direction if it goes 50 basis points? That's why we look at the technical analysis to hopefully give us some insights. Then we have the big one. This is probably going to be the reverser, FOMC press conference. Remember, a lot of the time, this number has pushed a certain direction. Then Papa Powell's come out and destroyed it down to another area. So FOMC press conference will be key for anybody trading currencies or even some of like things like gold and stuff. It is absolutely stacked on Thursday. Retail sales also coming out, showing us probably some demand destruction. And then we go into even more data on Friday. I mean, this is a week that I just don't see that often. It's trillions of dollars of options expirations, huge amounts of economic news. It's a true blockbuster. And I just think we have to expect some serious swing volatility. Good luck out there, everybody. If you're interested in following along, then make sure to do so by following @FXEvolution on Twitter, joining our Discord, and of course, subscribing to the channel. Do also remember, competition closes very soon, so why not enter it? It's free to do so. Thanks so much. Catch you in the next one. Bye for now.